live on YouTube.
Excellent. So I'd like to call the investment committee meeting to order, and I'll ask Ellen to take a roll call for the meeting.
Certainly, thank you. Good morning, everyone. Trustee Bartholomew.
Yes.
Trustee Donnelly.
Present.
Trustee Irwin.
Present.
Trustee Gardner.
Present.
And Trustee Martin.
Present.
And we are all set.
Excellent. So I'd just like to remind everybody, of course, this is almost like you memorize what I'm going to say here. To remind meeting participants to place your mics on mute while not speaking, and obviously place them on unmute. Remove the mute whenever you're speaking, or else we're going to say you're on mute, which I guess is the most popular phrase of the year. So I'd like to introduce the first agenda item and turn the meeting. The first agenda item is the FY 2022 endowment spending rate. And I'm going to turn the meeting over to Tracy Elliott. This is an action item, and go right ahead, Tracy, without further ado.
Thank you, Chair Martin, and good morning, everyone. The first item is an action item, and we're asking you to approve an endowment spending rate for fiscal year 22 of 4.5%. That will substantiate a distribution of $6 million, and it's consistent with the prior year, which was also 4.5%, and in fact, going back to fiscal year 2013. The chief business officers did take a look at this rate, trying to determine whether or not it might need to be increased because of the financial challenges, but ultimately determined in order to be prudent and not cause some endowments to potentially go underwater, as well as to maintain intergenerational equity, that they wanted to bring to you today their recommendation of the 4.5%. I'm happy to take any questions about that. We did review it in a little bit of detail back in December, but we wanted to take some time to discuss it further.
Any questions, any discussion on the spending rate?
It'll come up later, I'm sure, in the discussions, but I'm just curious if we're all comfortable that we would expect something equal to a greater return this year on our investments than the 4.5.
So far to date, and certainly invite NEPC to talk about that, but to date, we certainly would expect that. But, you know, it's volatile times and that can undo itself in a matter of a day, but would look to NEPC to comment on that as well.
Sure. Hi, Mark. Hi, everyone. This is Kelly. We're going to talk a little bit today about asset allocation, our outlook on the market, and assumptions for asset classes. And when we look at the three portfolios today with our assumptions on the asset classes, we can support all the returns for all three portfolios, including the MIP. We run these assumptions quarterly. So we're going to be running them again for an end date of March 31st and providing letters that we typically provide to Tracy so she can use those with her actuaries based on returns at that point in time. I wouldn't expect them to change dramatically and would assume that we can still support the return assumptions.
Okay.
I would add just one comment. When we present these assumptions to you, they really are long-term in nature. We historically have showed you 10-year, average annual returns for the upcoming 10 years and also average annual returns for the upcoming 30 years. So we precisely don't know what's going to happen this year or next year, but we look at it over a period of time.
Okay.
And I would add that, I'm sorry, go ahead.
I was looking for just a snapshot of what the view was going forward, and it sounds like Kelly and Jay have given me that, so that was good. And we'll get more of it later here.
And I would just add that under NEPC's recommendation, we also reduced the long-term assumption going into fiscal year 20. It used to be 7.5% for the long term, and we reduced it down to 7.25%.
Okay, good. Thank you.
So Kelly, you're on mute.
Oh, I get it. Any other questions, concerns, comments? No, hearing none. I'll read the text of the proposed resolution. that the Board of Trustees, acting through the Investment Committee, approve an endowment spending rate of 4.5% for FY '22. Can I have a motion?
Moved.
Second.
Moved by- Is that Chair Irwin or is that Sven?
It's Jim Donnelly and Sven.
Oh, my goodness, I'm very off on that. Moved by Jim Donnelly, seconded by Sven, and I'll turn it to
Yeah.
you, Ellen, for a roll call.
Thank you. Trustee Bartholomew,
Yes.
trustee Donnelly,
Yes.
trustee Irwin,
yes,
trustee Gardner,
Yes,
and trustee Martin.
Yes.
The motion is carried.
I see you got another mark popped up and it's not me.
No, it's Ann Devine from MMA.
Okay, good.
Mark, you're everywhere. So moving on.
And what you should do is change the name to your name, so your husband Mark has a problem when he gets on next time.
That's funny.
I love that.
Okay. The next tab, we're gonna go over to market outlook and performance review, the MIP, the MIP, the pension, and the operating funds. And I'll turn the floor over to either Jay or Kelly from NEPC to take over from here.
Okay, great. Thank you, Kelly. And again, good morning, everyone. It's hard to believe that it's been pretty much a year that Jay and I have been able to see you in person. It's great to see all your faces today, but we certainly wish we could be in person with all you like normal times. Today, Jay and I are going to walk through a market update through the end of 2020, because that's the performance that we're going to review with you today. We're also going to provide you our market outlook going forward and the themes that we see in the market that we think will drive markets and performance going forward. I'll have Jay do that, and then I'll review performance for the portfolios. And a top line note is through 2020, the portfolios, all four of them did really well. There's some great numbers that you'll see. The majority of the investment managers were able to add value. So you'll see some really good results from an absolute return perspective, a relative return perspective, and actually a ranking perspective versus peers for the managed investment pool. We have two action items today. One is a recommendation on core bonds for the pension and the operating fund. We do not have any asset allocation recommendations today, which we typically review with you during this meeting. And then lastly, if you remember, we did approve a new asset allocation for the MIP at the last meeting. So we do have just a slight change to the investment policy statement for the MIP that we'll review with you as well. So again, two action items and the rest is just review material. So with that, I'll turn it over to Jay, and I would assume everyone would like me to share the screen to walk through the presentation, or is it easier for you to view it on your own?
I like the
Please.
screen personally.
Okay, great.
Yeah.
All right, let me get that set up. So bear with me a second here. Okay. And oops.
It's also helpful to share the screen for those that are tuning in through the YouTube.
Perfect. Okay, can everyone see that? Great.
This is the time where I tell everybody to put their glasses on, or Kelly's going to have to enlarge the screen a little bit on occasion. Perfect.
Okay, we'll start with that. Let me know if there's any issues. I'm going to go on mute and turn it over to you, Jay.
Great. Thank you very much, Kelly. Obviously, returns as of December 31st seem quite dated because a lot has occurred in the last number of months. But I really just want to highlight how strong the markets were from an equity and a fixed income perspective during the fourth quarter. And you see the numbers in the upper right and also the lower left. So regardless of what you really invested in, you did incredibly well. Equity investors were really looking past the COVID markets into what could be called a new normal. And that really propelled those returns. And then on the fixed income side, we had lower interest rates and further spread compression leading to wonderful returns on the fixed income side. If we do turn to page 9, Kelly, and these are just the raw numbers on a trailing perspective. And I really want to highlight two rotations that really occurred in the market during the fourth quarter. And the big questions, are these rotations the beginning of a trend, or is it really just an anomaly? And that remains to be seen. Time will tell. Really, to set the stage for these trends, if you look at the 10-year column, you really see that U.S. markets have done significantly better than international emerging markets really over the last decade. And that occurred really on a consistent basis. So when you look at the S&P 500 over 10 years, you received an amazing 14% annually during that time period. And then if you go down to the international equity markets, you see international developed, again, stocks companies very much like the S&P 500, but they delivered almost a third of the return at 5.5, and emerging markets were even worse, up 3.6. But take a look at what occurred during the quarter. Even though US markets were incredibly strong, up 12.1%, international emerging did significantly better, up 16 and 19.7. And again, we think you should be rewarded for investing internationally and in particular emerging markets, and that just hasn't occurred in the last decade. So hopefully diversification will come back in vogue and people will be rewarded for doing that. The second potential rotation that occurred in the fourth quarter is growth versus value. Really in the same vein, growth stocks did significantly better than value over the last decade. If you take a look at large value and large growth, which is about 2/3 the way down the domestic equity, over the last 10 years, you see large cap growth up 17.2 and large value only up 10.5. And take a look at what occurred during the quarter. Large growth was up 11.4 and large value up 16.3. As a result, some of your value managers, and again, that was replicated in international markets as well as emerging markets. And because of that, some of your value-based managers did quite well, during the fourth quarter. And again, some names that come up are, Morgan Stanley and DFA that have been particularly more problematic more recently. If we turn to page 10, we do have some January numbers here. I'm not going to spend a lot of time looking at this, but the equity markets did take a breather. Those are on the top portion of the page. And you see some negative returns actually coming out of the fixed income benchmarks down below. And that's because we've had rising interest rates more recently. But February was strong, and I'm going to throw out a couple of numbers, and they aren't listed here. But on a year-to-date basis, even with the negative returns posted in some markets during the month of January, the S&P is up 1.7 through the end of February. The EAFE index, which is international developed, is up 3.6, and emerging markets are up 3.9%. And again, to show that fixed income markets have been impacted due to these higher rates, the Barclays aggregate index is now down 2.2% through the end of the month on a year-to-date basis. If we turn to the next page, page 11, Kelly. I did want to highlight how unique the market has really been during 2020. And we have three of the most recent, most significant crises in financial markets history. You've got the COVID crisis in dark blue. You've got the 2007-2008 financial crisis, really in the light green. And then in the darker green, you have the crash of 1929. And what this shows you is how many days, how the markets moved, depending upon how many days transpired into the crisis. And what's really interesting, if you look at this chart, you see that during COVID, really during 2020, the markets got back to pre-COVID levels roughly 140 days after the crisis occurred. And really this was brought about by central banks as well as federal governments providing an unprecedented amount of stimulus during this time period, not just here in the United States, but also across the globe. What's truly interesting in previous crises, even though stimulus did occur, not to the extent that it did this year, during that same 140-day period, if you look at the 2008 financial crisis, the markets were still down roughly 35%. And during the crash of 1929, the markets were down roughly 20%. So again, the recovery that we have has really been unprecedented at this point in time. Kelly, if you turn to page 13, I wanted to highlight to you some of the key market themes. And as Kelly mentioned earlier, we come up with these key market themes on a quarterly basis, as well as our asset class assumptions for forward-looking returns. And these 4 themes should be incredibly familiar to you because I think we've reported on the same themes really for the previous 9 months. Virus trajectory, permanent interventions, globalization backlash, as well as China transitions. On the next page, it goes into a little bit more detail on those, as well as if those are dominant or fading, type themes. And obviously this virus trajectory and the permanent interventions are the dominant themes, and really detail how critical it is for virus to really minimize the virus concerns out there so the economy can get back to normal, whatever that might mean, and that Americans can really stand on their own 2 legs going forward. Regardless of what happens with the virus trajectory, I still think these permanent interventions are going to be here to stay for an extreme amount of time. That might be the new normal, this permanent interventions. Lastly, let's take a quick look at the forward-looking returns. And Kelly might have a couple of more comments about this in her section. But you do see lower expected returns generally across the board, due specifically to the outsized returns we've gotten more recently, particularly in the equity markets. And the expectations for fixed income are actually quite low as well, because yields are low at this point in time. So if we just take a look at some of these 30-year expected returns, large cap equities, we expect a 6.3% return, and you get premiums for investing overseas. Non-US developed equity is an additional 20 basis points, and then you take a big leap forward in regards to emerging markets up to 8.4. If you go down to fixed income, you see the expectations are quite low, particularly in the short run. But over the next 30 years, we only expect 2% out of US Treasury bonds. To take different forms of risk, whether it be currency risk or credit risk, you are able to make a premium. You see US high yield corporate bonds. We expect a 5% return over the next 30 years. It's important to note that even though these look fairly low, through active management, you can generate higher returns than our forward-looking expectations. As Kelly mentioned, there's nothing here that changes the recommendations we've already placed in front of you. So if we look at the 3 pools of assets that we consult on, we have no asset allocation recommendations, and we're quite pleased with the way the portfolios stand at this point in time. I guess on those comments, does anybody have any questions about the markets or our forward-looking expectations that I might be able to answer?
Jay, just a question, and it's more about your thoughts, and we're seeing reduced, well, from this presentation and what I'm hearing, there's a bit of a reduced expectations for the next several quarters in terms of stocks, and then we're also seeing at the same time some real back-end interest rate pressure, long-term, 10 years further. And then I'm curious if that changes our risk profile, or does that change how we want to be blended in terms of diversification?
Offhand, it does not, but I would expect, because of the higher interest rates we're seeing when we come out with our assumptions next quarter, I would expect some boosts in expected returns in fixed income. Obviously, when interest rates go up, you get short-term losses in your fixed income investments. But again, the managers out there are buying bonds that have higher yields, so it'll generate larger long-term returns. I will say our expectations on these markets does change how we want to implement some of these asset classes. And Kelly will speak more to that. And there's a recommendation in regards to that. Again, that recommendation does not change our asset allocation, but it does change implementation on the margin. Does that answer your question?
Yeah, and then just to kind of follow up, and the story still remains a growth story, not a value story, as you've kind of alluded to earlier, that's really where we've seen our market winners. And so that cycle, it really seems to be rewarding those that remain in growth. It's just.
Yep, Sven, I would agree with you 100%. I think it's prudent to have a balanced portfolio of both growth and value, but it is not time to give up on growth at this point in time. I think the technological advancements that we're seeing, really highlighted by how our work has changed, over the last 9 months to a year, really highlight the fact that I think growth stocks will be here to stay for quite a while. But we still have to, as growth markets continue to accelerate and provide good returns, I think that does give us rebalancing opportunities. So we have to maintain value. But growth is going to be an integral part on providing great returns for your portfolio going forward.
Thank you.
You're welcome. Any other questions before we move on to the meat of the materials today with Kelly? Okay.
It's just a comment. It's March 4 today, and it's amazing. Last year at this time, we were aware of the virus, but it wasn't a huge threat until probably 2 weeks from now. And it's amazing what's transpired. And I don't know if any of us could have written the story of how the investments would have played out. I mean, it was a little bit scary come the end of March to look at statement balances and to just predict where, what was going to happen. Everybody was home scared. And so it's amazing almost a year later, from the shutdown of going to remote learning and everything, that we're here and things are looking the way they are. So feel fortunate we have good guidance and a good asset allocation, because even though technology has really sang the song this year for us, some other parts of the asset allocation have also played well for us as well. So
great. Thank you very much. I'll turn the meeting over to Kelly right now, and I'll go on mute.
Okay, thank you, Jay. And Kelly, thank you for those comments. I think what we saw with your portfolios is they held up really well during that first quarter and protected on the downside, and then we're able to participate in the upside. And so when we go through the results, I think you'll see that story. So I appreciate those comments on the asset allocation. Okay, so we have the MIP executive summary to start. I'm going to walk through the executive summary for all three portfolios and then talk a little bit more about managers. But just to start here, in the top left, you can see the pie chart diversified across a number of asset classes. You can see plan assets were about $412 million at the end of 2020. This is about a $42 million increase over the last quarter. We had very small net cash outflows and about investment gains of about $42.5 million. So it really was a strong quarter for the managed investment pool. When you look at your asset allocation, it is in line with investment policy targets and ranges. Again, we are going to be showing you an updated investment policy statement, which just adjusts some of those targets and ranges to take upon that recommendation that was approved at the last meeting to reduce global asset allocation and increase U.S. equities and core bonds. When you look at performance here in the top right, the composite And the first line is this portfolio. You can see the returns for the full calendar year up almost 13%. When you compare that to custom benchmarks for your portfolio, right in line. So that means that managers in aggregate did quite well. So there was some outperformers, some underperformers for the full year, but on aggregate, right in line with the benchmarks. When you look at rankings versus peers of similar size, other endowments of similar size, you ranked above median in the 44th percentile. So the plan did very well on an absolute basis, on a relative basis, and on a peer ranking basis. And for your fiscal year to date, which is the last 2 quarters of 2020, you can see some very strong returns, up 18%. Managers adding about 60 basis points of value during those last 2 quarters, and rankings, again, very strong, almost in the top third of peers, and similar results for the quarter. We've made a number of improvements to this plan through the reduction of global asset allocation, through the balancing of those growth and value exposures really over the past few years. And I think you're seeing the results really play out and how we would expect and some improvement in the portfolio. Over the last 3, 5, and 10 years, some strong absolute returns here, but you can see some of that manager shortfall when you compare the plan versus the allocation index. And that's what we're trying to improve with some of these changes that we've been recommending. In terms of recent actions, we did rebalance it in the quarter to get closer to those newly approved targets. You'll notice GMO, the manager that was terminated, it was terminated at the end of 2020 on 12/31, and we moved money into US equities and core bonds. The recommendations today I mentioned before is improve the investment policy statement for this portfolio, and we have a couple other recommendations for the other plans. Moving forward to the pension, asset allocations here in the top left, a little over 26 million at the end of 2020 for the pension fund. And this was an increase of about 1 million from the quarter below. We had investment gains of almost 2 million, which was able to cover the benefit payments, the cash outflows for the quarter in excess, which was great to see. In terms of plan or fund performance, again, the composite is the pension fund. For the 1 year, you can see a 12% return here. So a very nice return for the pension fund, outperforming about 170 basis points versus the allocation index. So managers in this portfolio did quite well, and we'll talk about some of those. Remember that there is a little bit more index in this portfolio compared to the managed investment pool. So you really had more of a balance of the active managers outperforming here, and then the passive investments matching their benchmarks, which led to some outperformance. You can see the fiscal year to date numbers, again, quite strong, up 11.4%, and over the quarter too, up almost 7%. So outperforming the allocation index over all time periods more recently. And then even over the 3 years, returning 7.2, outperforming the benchmark there, and kind of making ground up over those longer term numbers, which will take time, but some very strong absolute returns. In terms of recent actions, we always rebalance this portfolio every few months or so to raise cash for benefit payments. So that occurred during the quarter. And then the one recommendation that we'll get to later on in the meeting is replacing the core bond index fund that you have through Vanguard with a manager that we're recommending, an active core bond manager, which is Baird. And we'll talk a little bit more about that later in the meeting. Moving on to the operating fund. When we look at plan assets, over 282 million. This was up almost 30 million from the last quarter, as we did see some inflows into the portfolio. When we look at the 3 pools, the liquidity pool, income pool, and total return pool, they are in line with policy targets and policy ranges. These do fluctuate on a month-to-month basis because of the inflows and outflows, and we continue to monitor them. In terms of performance, remember the operating fund is about 30% in cash investments. So when you see the absolute returns here, they are going to be lower than the pension fund in the MIT, but pretty strong results comparing that cash has been earning 0 over the past year or so. So for the 1-year time period, up almost 7% for the operating fund, and about 170 basis points of value add from the active managers in this portfolio. Some of the fixed income managers with credit in their portfolios did quite well during the 1 year. And then even one of the global asset allocation managers, PIMCO, did quite well. You can see over the fiscal year today, off to a good start, up over 5.5%, and a really strong quarter. Longer term, you can see the results over the 3, 5, and 10-year periods, all outperforming the benchmark. So over this portfolio specifically has had really good manager value add over all time periods and has been earning more than cash because of some of the diversifying investments into fixed income to earn a little bit more yield. And then there is some equity exposure. We do have Vanguard Core Bond Index in this portfolio as well. Again, and we're going to be going through a recommendation to recommend to you that you replace Vanguard with Baird, an active core bond manager. If I could move on to manager performance. This is a page, and I know these numbers are really small, but this is the MIPS manager performance. And I'm going to focus on the 1-year column. I think what you'll see as I walk through some of these managers, a couple themes. One is we had a number of investment managers outperform their benchmark, which is really great to see. Some of those managers outperformed in the first quarter of 2020, so they didn't have to claw back as much because of that downside protection, and was able to keep up when the markets were rallying through the rest of the year. But you'll also see that some of these managers, even the growth managers that have a little bit of a more valuation focus, a little bit of a more value tilt to their growth philosophy, underperformed a little bit. And then certainly some value managers that are pure value, really lagging the markets just because of that value growth dynamic that Jay spoke about. So just to start down here, we have the small cap managers, Westfield and DFA. Westfield is considered growth. But again, they focus on valuations. We consider them growth at a reasonable price. And then you have DFA, which is a true value manager. You can see for the 1-year time period, Westfield certainly did outperform DFA, again, because of that growth bias. But when you look at Westfield versus the benchmark, they did underperform about 7% or so, ranking just a little bit below other small cap growth managers. So not a poor ranking, as managers with a growth process that have a little bit more value tilt will underperform a little bit versus peers. The more aggressive growth managers would be your managers that were the ranking quite high. No concerns with Westfield. They continue to do quite well. You can see fiscal year to date above median, longer term right in the median of their peers. Again, having a little bit more of that valuation focus has lagged other growth peers. DFA, again, positive returns for the 1 year, up almost 4%, right in the middle of the pack of other small cap value managers, ranking around the median. And you can see some stronger performance over the fiscal year to date and quarter. And then longer term, right in line with the benchmark, ranking right around median. So again, we continue to like these managers. We continue to think they have a fit in your portfolio, but it's just important to note that they do have a little bit more value focus than some of the other peers. Walter Scott is a newer manager, global equity manager that invests in US, international, and to some extent, but not a lot in emerging of small exposures there. You can see they're off to a good start versus their benchmark. They've been in the portfolio less than a year. And then with the international equity managers, Morgan Stanley did have a really good year. Even though they do have a value focus, they were able to outperform the MSCI EAFE by about 3 to 4% here, 11.4 versus 7.8, ranking really in the top third of their peer group of other international developed managers. However, you can see that as the markets continued to rally later in 2020 and really in the fourth quarter, Morgan Stanley did underperform during those 2 time periods just because they are not going to outperform when markets are rallying. The outperformance really in the 1 year time period was protecting on the downside and then just keeping up slightly as the rest of the year went on. J.O. Hambro, a newer manager for the full fiscal year to date, outperforming, ranking above median, which is great to see. This is a manager that we placed in the portfolio that does have a little bit of a growth tilt, not an aggressive growth tilt, to really balance some of the Morgan Stanley slight value tilt. And they're off to a good start. And then Kabouter, 1 year time period, just in line with their benchmark, ranking above median. You'll notice that the more recent time periods, they're underperforming their benchmark, ranking in the bottom quartile of their peer group. With Kabouter, what you're going to get from them, again, is that downside protection. They outperformed, I think, by about 12% in the first quarter alone, and then continue to have absolute positive returns Q2, Q3, and Q4, as you can see here. But again, they're not going to be outperforming the benchmark. So it really was that Q1 performance that allowed them to match the benchmark for the 1 year time period. And then a nice bright spot of the portfolio is your emerging market equity managers with both Aberdeen and Mondrian. Both managers outperforming their benchmark over the 1 year time period. Aberdeen, has consistently outperformed their benchmark over all time periods, ranking really above in the top third over most of them. And Mondrian's had a really nice comeback, again, protecting in Q1, leading to outperformance for the 1 year, ranking above median. But you can see when the markets continue to rally quite sharply in Q1, falling short there. But Mondrian has been a manager that we've looked at a number of times with all of you, and it's really nice to see that their performance is bouncing back as we would expect, and having the patience to stick with them is really paying off. Moving on to fixed income, we have Common Fund here, which is your core bond manager. You can see for the 1 year time period, right in line with their benchmark, ranking a little bit below median. Common Fund did have a difficult Q1. They do have credit exposure, some distressed credit exposure, and even some what we'll call private credit exposure, a little bit of a lockup credit exposure for about 5% of their portfolio, which struggled in Q1. But as you can see through the later in 2020, they did start to outperform as those credit spreads narrowed and they were able to capitalize on the credit markets. You can see over the long term, they've done quite well versus their benchmark. Having TIPS in the portfolio up 11% for the 1 year time period helped the portfolio, as we did see Treasury rates decline. So that was a nice exposure to have in the portfolio. And then your two return-seeking credit managers, BlackRock and Bain, did quite well, outperforming their benchmark, outperforming peers for the 1 year time period. Again, really capitalizing on the credit markets. BlackRock does have exposure to high yield, which did quite well in 2020 as the Federal Reserve came in to provide liquidity to those markets. They also have emerging market debt exposure, which did quite well. And then Bain, as your bank loan manager, they do also have the ability to flexibility to allocate to high yield, and that proved their portfolio well and outperformed the bank loan index. Newton is your one global asset allocation manager in this portfolio and also in the pension plan. We had GMO up until the end of the year, as I mentioned. And Newton is doing exactly what we want them to do. It's not really shown here, but in the first quarter of 2020, they did protect this portfolio, but they are going to lag when markets are rising quite strongly. They were able to have an absolute return of about 10%, but they did lag their benchmark, which is what we would expect in the 2020 market that we saw. But surprisingly, over the last 1 year and 3 years, you can see that this is one global asset allocation manager of a group of peers that is good to have. They outperformed over 60% of peers, ranking in the 40th percentile for the 1 year time period, and they're in the top quartile for the 3 year time period. So still a very strong global asset allocation manager. These managers typically are hard to benchmark because they look very different than the 60% MSCI ACWI, 40% Barclays Global Aggregate, as they do hold some commodities, gold, precious metals, very diversifying assets that are not captured in this benchmark. And then Lighthouse, your long-short equity manager, did exceptionally well over the 1 year time period, up 25%, which actually outperformed the S&P 500 during this time. which is not something that you would typically expect, given that these types of managers, when the S&P 500 is up strong, they're usually lag the S&P 500. They're really designed to protect on the downside, but their outperformance in Q1 was exceptional on the downside, and they were able to participate in the rally. They have the fund-to-fund manager, so they invest in other equity long-short hedge funds, and they have exposure to specialist managers like technology and healthcare, which were really able to capitalize on some of those themes that we saw in 2020. So very strong performance, very happy with this Lighthouse exposure in your portfolio. And then Landmark is your secondary manager. I wouldn't take the 1 year time period to be too much. It's really a number as of 9/30. I think when we see that the Q4 numbers in the next report, it'll be a little bit better. Over the last 5 years, about a 7.8% return for this exposure. And when we look at it on a more of an IRR basis, it's more like a 12, 15% IRR return, which is what you would expect from them over time. Moving on to the operating fund. I talked about a number of these managers when I went through the MIP. So I'm just going to point out a couple that are not similar to the MIP and the pension. One of those is being Income Research and Management. This is your short-term U.S. government credit manager, up over 5% for the 1 year time period, ranking in the top decile of other short-term peers. They certainly do invest in credit, which is why you can see the outperformance versus the benchmark. They have a little bit more credit than the benchmark, and therefore they did have some strong outperformance. Still a high quality manager with about 26% of this portfolio, and they've done quite well. Loomis Sayles is your bank loan manager. And when you look at the results here, I just reviewed results for Bain, which is the other bank loan manager in the MIP and the pension. Loomis Sayles is more conservative than Bain. And so when you look at these numbers, and even if you look at the benchmark that we compare Loomis to, it's very different than Bain's benchmark. This is more of a higher quality bank loan manager. And because we saw more of the lower quality part of the bank loan market run in 2020, you will see some underperformance here. But again, the absolute results are good. This is a manager that we're going to continue to look at. But for a very conservative portfolio like the operating fund, at this point in time, we still think Loomis Sayles makes sense. And then the last manager I want to point out is PIMCO down here at the bottom. So in this portfolio, you have Newton and PIMCO as your global asset allocation managers. You can see some very strong absolute and relative returns for PIMCO over all time periods, some nice rankings for them. More recently in 2020, their emerging market equity exposure, they actually had exposure to long treasuries, which did quite well given the falling interest rates, and some emerging market debt exposure really helped this manager achieve these results and outperform their benchmark. So I will stop there on performance. I know I just covered a lot of different items from plan performance to manager performance. So I'll stop there and just see if there's any questions. Happy to flip back in the presentation to answer any questions.
So Kelly, question for you. So one, lot of information here, and to really make actionable sense of it. I'm just curious, when we look at these managers' performance, whether it's quarter over quarter or month over month, do we kind of stack rank them related to peers and say, and I believe we do at some meeting during the year, but I just want to kind of double check and say your performance this year was down, but that's because it was a bull market and you were focused on asset preservation. But do we stack rank these yearly, and do we do year over year trending with these, or that to me that feels like an important component of this when we're looking at this much information.
Sure. So I'll say we do a couple things. So we look at, I went through the 1 year mostly just to show you kind of how these managers recently did. But we obviously show the 3 and the 5 and 10 year results here and those rankings next to them. We kind of look at them on an annualized basis versus rankings. again, not only from a performance perspective, but from like a due diligence perspective, making sure that from NAPC's research side that we still have high conviction in these managers, that there's nothing changing at the firm, that there's nothing changing with their investment process, and they're sticking to everything is another thing that we monitor. I can say that all the managers in these portfolios are 1-rated managers at NAPC. So that's another thing that we look at. Certainly some of these managers are going to do well one quarter, not do well the next quarter. So we try not to focus on it quarter by quarter too much, but really try to focus over the last 3, 5, and 10 years. And I think these managers, when you look at them over a long-term basis, have really been doing what we would expect.
And then maybe an off-topic question, but one that came up from our previous meeting. There was a discussion around 0 or negative returns in money markets, and I'm just curious where we're at. Just kind of an update in terms of that thought process.
Sure. So certainly have, I'm on the operating fund right now. Certainly, for the last year, getting 60 basis points of value out of the 3-month T-bill. You can see the state pool does still continue to offer some value above that, investing a little bit outside of just pure money markets. Certainly with rates low, we want to be considerate of that. However, we also want to be considerate. We want to make sure that there's liquidity in this pool, given some of the pressures from 2020, and make sure that there is cash available when it's needed, not really having to tap into the income pool and the total return pool too much. We do have ranges around this 30% policy target. So we can underweight, overweight, depending on the views on the market. We don't typically do that too much. But I would say right now, from our perspective and given our understanding of liquidity needs, we think that this 30% is the right number, even though unfortunately not earning too much on it, but for liquidity purposes, we think it makes sense. And then to balance that with higher yielding and even a little bit more risky assets to make up for those low rates.
And and I understand that, and that's a good explanation. But so we're hovering near 0 on at least in the short run on some of this money, but it's not negative.
Correct.
Okay, so we're okay. Thank you.
I mean, after inflation, it technically is, but
right.
Yeah, but from the return perspective that you see here, it's 0.
Kelly, can you speak briefly about cash flows that occur in that operating pool and what the purpose of that bucket of assets are to show that it is under stress from a cash flow perspective?
Sure.
So that isn't stagnant money, I guess I'm saying, even though it would appear to be that way.
Yep. So I'm going to show a couple pages here. So this is just balances by these lines here. And it kind of shows the inflows and outflows on average over the last 5 years. So you can see that, August, September, we get some sizable inflows, start of the school year. January is the biggest inflow period for the operating fund. Again, starting in the second semester, but you do have these outflows, right, for the rest of the year that we have to manage, make sure we have liquidity for all of the operating expenses that this operating fund is there to serve. And then you can see on this next page here, just kind of how dramatic they can be, right? So we get these large inflows. We want to make sure that, we hold enough in cash to cover us from really February through August until the next inflow comes. And then if there is any excess cash that we think is able to be invested, we certainly can put in the income pool and the total return pool, but we really just want to be mindful of transaction costs and just making sure that there's enough liquidity there to capture what's really needed here. Does that help answer your questions, Sven?
It really does. Thanks, Kelly.
Okay. Any other questions from the group? Okay.
Kelly, Could I ask your comments about the private equity landmark and, the negative performance relative to the benchmark? And you commented about IRR. And I'm curious how we think about that and when we might expect to see that reflected in the performance numbers that you provide.
Sure. So let me move to that page for a second here.
Kelly, if I'm correct also, while you're looking at that, the landmark investment probably is indicative also of third quarter data, not fourth quarter data. And fourth quarter was a amazingly strong quarter. So you're going to see those numbers go up dramatically from what is in that report. On all those private investments, there is a quarter lag, which is common in the industry.
Sure. Thanks, Jay. So just as a reminder, we invested with Landmark in 2014. So they're really out of their investment period by now. So what I think you'll start to see is those longer term numbers that we show on this report. I think we're showing about 8%. Their longer term numbers are more about 10% on an IRR basis. As you get more and more history, more and more time, you've earned your way out of the J curve, which is the negative cash flows. I think over time, we'll start to see those longer term time weighted returns that we show on the flash match up a little bit more to these IRR returns that we're showing here. But it is about 11% at this point in time for Landmark. But again, you'll have over the shorter term, the quarter, the fiscal year today, and the 1 year, sometimes have those funky looking returns until you get the write-ups, until you get that quarter lag out. So the next quarter, as Jay mentioned, Q4 was quite strong. You should see those results on your March flash report.
Thank you, Kelly.
Any other questions on performance? Okay.
Kelly, are
Kelly-
you gonna continue on to the recommendation, NEPC recommendation to replace Vanguard with Baird?
I am. That would be
Okay,
great, Kelly. There is one question I do have for the committee before I do that. In this report that we send you and that we, post here for our meeting, we typically, as you just saw, we go through what we call the executive summary. We go through the pages from the highlight perspective on overall plan performance, overall asset allocation, looking at the manager performance. We'll comment on if there's any manager updates. We call that the executive summary, and that's what Jay and I typically spend our time on with you all. Later in this report, and I'm just going to go to a few pages, we have what we call the supplemental performance. We show you a lot of pages really driving into asset allocation, plan performance. We'll show pages like this one, which shows you rankings, which is really shown again on the executive summary. We'll show you pages about risk and return, but then really what we call manager pages is we have a page for every single investment manager across all three portfolios here that provides more details. If we have a concern on these managers, or if we're going to talk about one, and you'll see that today with Common Fund, we typically pull these pages up into the executive summary. What we've been seeing from a number of committees that Jay and I work with is that they really have been focusing on more concise data, looking at these executive summaries, really just trying to focus on the main points and not typically focusing on these pages. So I wanted to see what your thoughts were. If the committee as a whole likes these pages, we're still happy to include them for you. Or if you're comfortable just to shorten this deck down for our meetings, if we remove these pages and just focus on the executive summary for our meetings. And certainly at NEPC, we can produce these pages at any point in time if any of the committee members would like to see them, but just wanted to see how comfortable the committee was if we just focus materials going forward on the executive summary and move these supplemental pages, which I think is about, maybe upwards to about 100 of additional pages in your book. So we can focus really more on the main points in these meetings. So I'll just stop there, see if there's any comments, questions, or if you need more clarification on what I'm asking.
Kelly, I think I would just say the presentation at the executive summary level is good. and then having the material in the packet as a supplement, so we could dig in if something stimulates a question, rather than create a back and forth, is helpful. It is great data. I will admit I didn't read all 100 pages, but when there was something that was a question earlier on, it was good to have the data to go back into. So I don't think it's wasted effort from my perspective, but you know, I'm one member and I'm willing to go along with the group if others think differently.
Appreciate those thoughts, Jim. Thank you. Thoughts from other members on preferences?
Yeah, Kelly, this is Mark, and I feel the same as Jim. The information is tremendous, but just having it as a backup and for us to be able to go into it and look at it is fine. I don't think you have to bring it up and make it part of the presentation, unless it's a question on something.
Okay.
Yeah, I'll just add that I agree with both of my fellow trustees on that point. I think the transparency is important for what we do, and both for us and for the public. So I'm comfortable with the way things are structured now.
Great. Well, we're happy to keep it in. Wanted to really see what your preferences were. If it's useful, great. We'll keep it in, and just keep things as they are. Okay. Let me turn to page 146 here. Bear with me. Sorry, there's not an easy way to get there when I'm screen sharing. All right, here we go. Okay, so we call this an asset allocation update and a core bond recommendation. Really, the asset allocation update is, typically at this meeting, we present to you our capital market outlook, which Jay already went through. We provide you our asset class assumptions, which we did show you a snapshot of those. And typically at this meeting, we'll show you the expected return and risk for all three portfolios based on those assumptions and recommend any changes if necessary. So the points on asset allocation is we have no recommendations on asset class changes for any of the three portfolios. And then given that your fiscal year end is June 30th, since we do quarterly assumptions, using our 3/31/2021 assumptions, we'll provide those to you at the next quarterly meeting, show you the risk return expectations, and also use those assumptions for the quarterly letters that we write to help support those returns. So again, we're not going to be providing any really asset allocation update in terms of recommended changes. Just really wanted to talk about kind of the process for asset allocation and what we plan to do going forward. However, even though there's no asset class changes, we do have an implementation recommendation that I'd like to go through, which is just for the pension fund and just for the operating fund. So here is the summary of the recommendation. We have two core bond managers that we use across three portfolios. We have common fund, which we walked through when I went through the MIP performance. And then we have in the operating and pension, the Vanguard Total Bond Index, which is passive. When we look at the marketplace and specifically core bonds and core fixed income today, it certainly has changed quite dramatically. We're seeing the market issuance really be dominated by triple Bs in the core fixed income space. And we're also seeing that credit downgrades have increased and have potential to increase further. And specifically, when we think about it in that triple B space, which is investment grade, then if it was downgraded, it would go down and more into the non-investment grade space. And so when we think about that and we think about how tight credit spreads are today, we think it would be value add in those two portfolios to really hire an active fixed income manager that really focuses on credit security selection to help mitigate any future downgrades in the credit space and really try to add value if we do see credit spreads widen out and protect the portfolio from that. And so with that, Jay and I have looked through all of our 1-rated core fixed income managers. And based on the portfolio construction and our thoughts on your portfolio, we think that Baird Core Bond, and I'll show you some statistics on them shortly, could be a really great value add to both the pension and the operating fund. They are really known for their strong credit security selection. They have a large credit analyst team really focused on that. And over time, that is really where their performance value add has come from. They're able to overweight and underweight credit sectors based on the attractiveness and value. Whereas with an index, you're just getting the index, whether it's attractive or not, those securities in the index. And then they're able to actually tactically tactically adjust their portfolio in terms of duration and based on the yield curve. So if the duration of the core bond index is 6, they have the flexibility to go below 6 or above 6 within ranges, which helps if we see falling yields. When we look at all the managers that you have today, we do have a note down here that common fund in the MIP, we're not recommending any changes to common fund in the MIP. And I'll show you a page on why that is. We still like common fund. They're neutral NEPC. They're a very well-diversified fixed income manager. We would expect them to be outperforming a little bit more than they are given their exposures. So again, there's really no huge concerns, but we're going to continue to monitor them, and they're based on our performance expectations. If there are any concerns with common fund in the future, we do think that Baird could be a nice replacement in the MIP as well. Again, not something we're recommending today, but again, we think that this Baird manager that we're bringing forward to you could work across all 3 portfolios if needed. So I'm going to start with just a quick overview on common fund and show you some of those reasons why we like them and why we're not recommending a replacement today. And so this is a manager that really is a fund-to-fund manager in core fixed income. So what they do is kind of similar to what NEPC does in a way, is they scan the universe, find their top-rated fixed income managers, and then invest in them accordingly. So what you'll see is they have about 80% of their portfolio in core managers. You'll see these names and you'll recognize a few of them. Income Research and Management, they invest in their core fixed income product. Western Asset Management, they invest in their core fixed income product. And then a manager by the name of Rimrock. So they have the majority of their portfolio in core fixed income. And then they offset that with some higher yielding, more return seeking type managers. So you'll recognize some of these names too. They have Bain in there, not specifically the Bain that you have for bank loans, but another Bain product. They have some lockup funds, so about 3 to 5 year lockup with Cerebus, which is a great name in the private credit space. They have some distressed debt partnerships, so they're trying to capitalize on some of that. And then they have some opportunistic mandates with Brandywine, which is a manager that can invest in emerging market debt, high yield, some of those diversifying credits, and then PIMCO Income Fund. So everyone knows the name PIMCO. So they have some of that exposure there. And then another opportunistic product for Western. So we think this gives you broad exposures, some diversifying exposures, some really interesting credit exposures. Again, it's not a big piece of the portfolio. It's probably only about 20%. And then they invest, in high quality core fixed income managers. So we think that over time, this should be a good strategy to continue to invest in. Another reason why I say that is when we look at this manager comparison page, we show common fund here with a number of statistics versus the Barclays aggregate index. And you can see the yield on the portfolio is 2.3 versus the index of 1.1. So certainly a higher yielding portfolio, very similar duration as the index, And then you can see the return profile here. You know, they have done better than the index over most time periods. We would expect, hopefully, that over the shorter term going forward, that they will continue to do better. They have an overall fee of about 50 basis points, which is slightly high for fixed income, core fixed income. But again, it's because of all that diversifying exposure that they do get you. And these returns here are net of fees. So it's really net of this 49 basis points. So again, no concerns with common fund. Really just wanted to point out why we're not recommending changing them today as well. We'll continue to see if there is a change needed in the future, but today we're completely comfortable with them. To move on to the recommendation for Baird for the pension and operating fund, we have some statistics listed here on Baird. You know, they have about 46 billion in this product alone. So it's a product that's widely used. You can see the yield for Baird is higher than the index. Again, it's not going to be as high as common fund, just given that Baird is a traditional core fixed income manager. It's not investing in some of those distressed debt or opportunistic credit mandates like common fund. And today you can see their duration is higher than the index. So again, they can move it higher or lower based on their macro outlook. Over time, you can see the returns have been quite strong compared to the index. And all this is really due to their security selection, their credit security selection. And they've done quite well over the last year. As we did see credit spreads narrow in, they were able to capitalize on that and do quite well. And their long-term numbers are very strong versus the index. Their fee is very favorable at 30 basis points. When we compare it to other fixed income managers, they're right in the middle of the pack. I will point out, though, that making this change will be a slight increase to overall portfolio fees for the pension and the operating fund, 30 basis points versus the 5 basis points that you pay Vanguard today. So I think at the last meetings, when we come in with a manager recommendation, you know, we come in, you know, say we think this manager is better for X, Y, and Z. And a lot of the times we come in and say you have a fee savings. So really, it's been a nice story. Today, it's not a fee savings, but we think that given the credit markets and the dynamics that we're seeing, that net of fees, the value add that you'll get from Baird will make up for that fee increase over Vanguard. We do have an investment profile that we've included in the presentation, which goes through the whole firm description on Baird, our thesis on Baird, who makes up the team, some of the philosophy and the investment strategy as well. But I gave you some of the high level points on who they are. So I'll stop there. See if the committee has any questions on our recommendation, any concerns. And then I think based on that, maybe this is an action item, maybe take a vote.
Any questions or concerns?
Kelly, the only question I have, Kelly Regan, is maybe kind of stepping back in kind of a high level perspective and say, okay, how many managers do we have in each one of these portfolios? And how has that changed over the last several years? And then kind of the second component of that is just and maybe we have it in some of the supplemental material, but an awareness of fees and how those have evolved in the last 3 or 5 years too. And just be aware of it. Maybe it's something to react to more than anything, but just kind of some thoughts as we because our recommendation today, at least on this, is to add an additional manager, and I understand why. And I'm just curious, how many managers have we added in the last couple of years? Have we added a tremendous amount more, or?
Sure. Yeah, so on the number of managers, so this isn't a recommendation for an additional manager. This is a recommendation for a replacement. So recommending terminating Vanguard and replacing with Baird, so a 1-for-1. Overall, I would say the operating fund, there hasn't really been any additional managers or any managers taken away. The number of managers in the operating fund has been pretty stable over the last few years. And fees have been pretty stable. We haven't made a lot of manager changes in the operating fund. In the pension, we've actually been reducing managers in the pension. We reduced Wellington opportunistic investment in the global asset allocation bucket. We combined an S&P 500 index, a Russell 2000 index, and Morgan Stanley International EFI manager with Walter Scott. So that's a big manager reduction, terminating 3 for 1. And then in the MIP, it's been a manager reduction mostly because of the global asset allocation area, where we had Wellington, GMO, and Newton, and now we only have Newton. So we reduced that portfolio by 2. And then additionally, more specifically in the managed investment pool, we've been reducing fees there. And a lot of that has come from the reduction in the global asset allocation managers, which are relatively high fees, 90 basis points, 100 basis points, and reducing that into the S&P 500 index, which we did last quarter, which is, call it 4 basis points, and the core bond manager and common fund, which is, call it 50 basis points. So we've been reducing fees, I would say mostly in the managed investment pool, significantly reducing managers in the pension fund, and then things have been quite stable in the operating fund. Does that
Thank you.
help answer your question?
Yeah, that's a good summary.
Okay. Any other thoughts, questions from the group?
Okay, so, well, geez, thanks to you, Kelly and Jay, for the year and quarter to date review of the 3 portfolios and the asset allocations, the MIP, pension, and operating funds. So just to summarize, we got a lot of information there. No recommendations, no recommended changes are being made in the asset allocation. We want to keep the supplemental detail in our meeting packets for reference. Presentations will continue to be based on the executive summary with supplements for reference. And last, we move forward to the text of the proposed resolution that the Board of Trustees, acting through the investment committee, approves the following investment manager change: replace the Vanguard Total Bond Index strategy with Baird Core Bond strategy in the operating fund and in the pension plan. Can I have a motion?
So moved.
Second.
Okay, moved by Chair Irwin, seconded by Vice Chair Gardner. And I'm going to pass it on to you, Ellen, for a roll call.
Is it possible to stop the screen share for roll call? Great, thank you. Trustee Bartholomew,
Yes.
Trustee Donnelly, Trustee Donnelly, Trustee Irwin,
Yes.
Trustee Gardner,
Second.
Yes.
Trustee Martin,
Yes?
and Trustee Donnelly.
Yes.
Great, the motion is carried.
Our next item on the agenda is an update on the investment policy statement. This is also an action item.
Okay, great. I'm going to share my screen again. Can you all see this? No, I know there's a lot of red line here, but
Yes.
okay. So this is a page from the investment policy statement for the managed investment pool. And really the only changes in this policy statement is to this table here, which details all the asset classes that the managed investment pool invests in, the target percentages to each of those asset classes, and then the range around that target. There's 2 parts of the investment policy statement where this table exists. But for the purposes of this, I'll just focus on one of those pages because the information's the same.
Okay, Kelly, excuse me. It's important to note that all these changes were approved in prior meetings. This just codifies it within the investment policy statement.
Thanks, Jay. That's exactly right. So at the last meeting, we approved, or you approved, excuse me, reducing global asset allocation down to 7.5%. So you'll see the red line here to a 7.5% target. And with that reduction from 15 to 7.5%, you approved adding 2.5% to domestic core fixed income up to 9.5%. You also approved increasing domestic large cap to 22% and reducing domestic small cap from 7% to 6%. So this is just putting those changes into your investment policy statement. Because the targets changed slightly, we did alter some of the ranges here. So around domestic large cap, going from +5 to -5 around that 22, so 17 to 27%, and adjusted, some of these numbers here at the total line fixed income, just making sure it's the ±10 at the broad asset class level. So again, all these changes were shown to you at the last quarter in terms of the recommendation and the presentation materials. This is just placing it in your investment policy statement for your records. The only other things that change are the date that this is being approved by. And then there is another page in here. Bear with me while I get there. Oh, I went to the clean document. The only other change is down here, and you're not going to see the red line version change, but it's just changing this fiscal year to 2022 for that spending rate was the other change. Again, it's not redlined on the clean copy, but just wanted to point that out.
Great. Do you have any questions, concerns, comments from the group? Okay. That being said, I'll read the text of the proposed resolution. That the Board of Trustees, acting through the Investment Committee, approves the updated investment policy statement for the management investment pool. Can I have a motion?
So moved.
So moved by Chair Irwin. A second?
Second.
Second by Trustee Bartholomew. And Ellen, I'll transfer to you for the roll call.
Yes, thank you. Trustee Bartholomew,
Yes.
Trustee Donnelly,
Yes.
Trustee Irwin,
Yes.
Trustee Gardner,
Yes.
Trustee Martin.
Yes,
The motion is carried.
thank you. And now, do we have, I noticed Mike Pratico is on. Barry, you're on too. So I'm going to transfer the meeting over to you to go over the defined contribution plans quarterly review. Welcome.
Okay, great. Well, good morning, everyone. I am going to, so Barry and I are going to split the presentation here. We have two basic agenda items, the quarterly review, which I'll cover at the initial stage of the meeting, and then I'll hand it over to Barry, and Barry's going to go through fee benchmark report and fee reduction as well from TIAA. So please just stop me at any time if you have any questions. And I'm going to go ahead and hopefully share my screen. And can everyone, can you see that okay? Just a nod from someone would be great. Okay.
Yes.
Thank you. Okay, great. Thanks, Kelly. I'm going to spend, I know that we're already, an hour and a half into the meeting. I'm sure you've had a lot of market commentary, so I won't spend a lot of time on market commentary. I do want to just give some very specific statements as they relate to funds in our plan, but I did want to go through just some very high level industry updates, things that are going on, whether it be regulatory in nature or just within the industry. But a couple things that we're keeping an eye on. First of all, is the Secure Act, which was a regulatory change that was made prior to the pandemic and the CARES Act. A new round of the Secure Act is being proposed and being met with very little resistance. It will include the minimum distribution age going up from 72 to 75. That was actually increased in the first round of the Secure Act from 70 and a half to 72. There's some other language in there around lost retirement accounts and auto enrollment as well. But really, the most impactful thing there, which if this is passed, is eligibility for 403B plans to access collective investment trust vehicles, or what we call CITs. That would actually be very, very meaningful, specifically to plans like the University of Maine system, because it essentially would allow you to access lower cost funds than you're even accessing now. So we're certainly keeping a very, very close eye on that. And as soon as something happens, we'll be quick to respond, again, because it would benefit the UMaine plan. The other thing that I wanted to point out, just in terms of kind of things that are going on in the industry, is the DOL released a final rule about financial factors in selecting plan investments. A lot of this actually revolves around things like ESG, or environmental social governance, or socially responsible investments. I know that's a topic that this committee has spent a lot of time on over the years. And essentially what the DOL is saying is, just to summarize it, that it's fine to offer socially responsible investments or those types of specialty investments. But what they don't want is for those investments to be getting any type of special treatment. And what I mean by that is, from a selection perspective, a monitoring perspective, the DOL really wants you to follow the exact same process for socially responsible investments as you would for any other investment within your plan. And I point this out because you do have a socially responsible investment in your plan. It's called the CREF Social Choice Fund. What we do with the CREF Social Choice is that we have that right in our core scoring methodology page, meaning we follow the exact same monitoring guidelines of the CREF Social Choice that we do for all of the other funds. So I wanted to point this out just so that you know that we are following that same process and following the DOL guidelines very specifically when it comes to socially responsible funds.
So Mike.
And then, yes, please.
Sorry to interrupt for a question already. Do you see a change in administration changing a little bit of how that's viewed, and what difference will that make to us going forward?
Yeah, great question. So I think from your perspective, at the UMaine system and as committee members, it really does not have an impact going forward, because we have and will continue to basically monitor the socially responsible investment just like we would any other investment in your plan. So we do have, in some cases, we have plans that have had to tweak their monitoring system if, for example, they're using a socially responsible index fund. But in your case, one, you already offer a socially responsible investment, and then two, it's already being monitored appropriately following those DOL guidelines. So on a go-forward basis, I really think it's business as usual. We just wanted to make sure to point that out. If in your readings outside of these meetings you saw something specific to socially responsible investments, you felt comfortable with the way that we're doing that. Good question.
The thing I would add to what Mike just said is, there was a little bit of an administration bent to this in the prior administration. Think energy and a lot of the fossil fuel exclusions that we've seen, especially at the higher ed marketplace. So we do see this particular administration perhaps at least softening some of that language, but based on the original document that went out and what was produced and what was finalized in the fourth quarter, it is much better than what it was originally. It was very rigid, and they've at least made this a little less rigid. But we'll see what the Biden administration perhaps might do.
Yeah, great. Thanks, Barry. Next page, just briefly, I left it up there for a few minutes so you could read it, but just some things we're really proud of at CapTrust in terms of the work that we're doing around inclusion and diversity. We have a very specific female initiative that has the result of which has been over 30% of our advisors at CapTrust are now female, over 30% of our leadership position are female. And then one of the things we're especially proud of in the last year, particularly, is that the CapTrust Community Foundation raised about $5 million and then really turned around and gave away $1.5 million of that to local charities. In Maine, we donated $10,000 to the Catholic Charities Maine food program, which I literally was just watching the news last night, and saw lines of people up in Aroostook County in their cars awaiting to get these boxes of food, which again, it was a really proud moment realizing that we funded, a big portion, or a portion, I shouldn't say big, but a portion of that. So again, just some things that we're really proud of. Moving to markets, again, I don't want to spend a lot of time talking about market commentary. I'm sure you've already heard a lot of it when you talked about the other plans, but I did want to point out that it was really a remarkable year in 2020 across all asset classes, with the exception of real estate, as you can see here. U.S. stocks, that's the S&P 500, closed up the year 18.5%. International was up 8%, with emerging markets leading the way, up almost 20% for the quarter and 18% for the year. And then bonds had a strong year as well. So it was a really good year in the market. As I get to your plan, you'll see it was a really good year for your plan and ultimately the participants in your plan as well. I did want to spend just a couple minutes on this slide, though, because it gets a little bit more granular in the things that went on in the market in the year 2020, and then also specifically in the fourth quarter of the year. And as I go through funds, you do have a couple funds that are underperforming. And I wanted to just use this as a to kind of tee up an explanation for the underperformance of specific funds. But you can see that for the year 2020, it was a year really driven by growth investing. So the more you leaned into growth as an investor, whether you be a participant in the plan or a money manager in the plan, you can see the more you were rewarded. So large, mid, and small cap growth up over 30% for the year. You contrast that to your value funds, or value, I should say, not your funds, but value. You can see the range there is about 3% to 5%. So the full year 2020 was definitely a growth year. And taking it a step further, I would say it was really a year driven by big tech. So the more you focused on big tech, the more you were rewarded as an investor. We did start to see a market rotation in the fourth quarter back towards value, and that's on the left bottom of this page. You can see value really did start to outperform in the fourth quarter specifically. In fact, large, mid, and small value led all the growth asset classes. So we've been kind of waiting for this rotation back to value. The market for an extended period of time has really been led by high-priced, high-valuation stocks. Big tech specifically has led the market. But, again, we started to see the early stages anyway of this rotation back to value, as you can see in the fourth quarter. So as we jump ahead, all the way ahead to your plan and the scorecard of the UMaine System plan, you can see on page 22, just a snapshot of the fund lineup. We continue to believe that you have a very appropriately structured fund lineup. You have all the critical asset classes covered on an actively managed basis, both growth and value. In addition to that, for investors who want just pure low-cost participation in the market, you have the Vanguard full suite of Vanguard index funds. And then really the foundation, I consider the foundation of most retirement plans these days to be the target date series. I think it's really important to offer a good quality target date series. And certainly the Vanguard series is as high a quality target date series as you're going to find. Vanguard target date funds had another very strong year. So we did see in the fourth quarter some mixed results just purely on the quarterly basis. But for the year, as you'll see on the performance side, the Vanguard target date funds outperformed in almost every single vintage year from 2020 all the way up to 2060. So really good year for the Vanguard target date funds. You can see the highlights on this page are some previously approved fund changes this was actually effective or will be effective tomorrow. So March 5th, the CREF money market will be closed, and all future contributions will be directed to the Vanguard federal money market. That was a conscious decision that was made by the committee last quarter, really as a result of some of the fee waiver issues around CREF money market. I don't feel like we need to go into that in detail again, but again, we think an improvement for the plan. John Hancock Disciplined Value is actually being replaced with the JP Morgan Equity Income Fund. We did see some lagging performance with the John Hancock Disciplined Value. Frankly, it was a fund that we still felt good about, but since we were making other fund changes, we always like to take a step back, look at the fund lineup in its entirety, and see if any other changes make sense. So John Hancock is being replaced with the JP Morgan Equity Income. John Hancock actually did have a strong fourth quarter of last year, and actually is off to a good start in 2021. And I'm not saying that because I'm second guessing the decision at all, but obviously it's nice to get out when the fund is up. That whole concept of selling high. So again, still believe it's the right decision, but performance-wise, that fund has turned around. And then finally, the DFA Emerging Markets Fund is being replaced with the American Century Emerging Markets Fund. And again, DFA ended up with a strong year in absolute terms, up about 14%, but we continue to believe that the American Century Emerging Markets will be a better choice for the plan. So again, just recapping some of the changes that will actually be made as of tomorrow. And then the next page showing total plan assets, and really just remarkable in terms of your total plan assets. I feel like your plan not that long ago crossed the $1 billion threshold, and then you can see here with the plan assets up to over $1.8 billion, and that's something that we certainly can see this plan as soon as this year even crossing the $2 billion threshold, and that's something that Barry will reference when we talk about the pricing, specifically kind of the benefits of plan asset growth. Any questions so far on anything that I covered? Okay, the next slide again just shows you kind of a breakdown of plan assets, but again, I just wanted to reference just where the plan started at the start of the year and where it finished, including kind of a big dip after the first quarter of the year. So just a really good year for the plan in terms of asset growth. From a scoring perspective, and I'm going to jump ahead to the CapTrust scorecard. There you go. To the CapTrust scorecard on page 42, you can see overall, I would say the plan continues to be in really good standing. You have one fund on this page marked for review. That's the John Hancock Disciplined Value. That's being replaced tomorrow with the JP Morgan Equity Income. So that's a fund that clearly will be in good standing, scoring in the 90s. The only other fund that you can see some due diligence notes are your bond funds, both the CREF inflation-linked bond and the PGIM total return bond. Really no concerns with either of those funds. They're both in good standing. The due diligence notes are some underperformance with CREF on a peer relative basis, and some volatility is reflected in that confidence column. But again, overall in good standing. The fund firm due diligence note really just references a number of high-level changes that we've discussed in the past at TIA specifically. PGIM total return bond, again, you can see scoring a 90 style there. We're seeing with a lot of these core plus bond funds over the last year where they've gravitated and kind of drifted and look a little bit more like core bond funds and core plus bond funds. That's a tactical move that a lot of active bond fund managers made in kind of late 2019 and 2020. The performance is really good with that fund, and the score is a 90, so certainly no issues there. Some highlights here on this page certainly would be your Harbor Capital Appreciation Fund, which is your large cap growth option. That fund was up 54.5% in 2020, and it beat over 90% of the peer group. Not surprisingly, if you look at the top holdings of that fund, you're going to see a lot of those big tech names, Facebook, Apple, Amazon, Microsoft, Google, that really drove the market. And again, that's a fund that is heavily weighted towards technology. And the result of that is, again, over 50% performance for the year. Interestingly, that's coming off a year in 2019 where the fund was up over 35% from a performance perspective. So anyone who is overweight large cap growth in your plan certainly has had a remarkable 2-year run. Excuse me. Similarly, the American Fund's Euro-Pacific Growth Fund, which we really view as your core international fund, is coming off an exceptional year. I mentioned that that the EFI index, international index, was up about 8% in 2020. Your Euro-Pacific Growth Fund was actually up over 25% for the year and beat 98% of its peer group. Part of that is the EuroPac has about 30% emerging markets exposure, and so the managers there really kind of saw that turnaround in emerging markets and went tactically overweight emerging markets, and were really rewarded with exceptional performance. So again, from a pure scoring perspective, as you can see, on this page, your core fund lineup really in good shape, with that one fund that's marked for review already scheduled to be replaced. The next page, you can see similarly your large cap, your foreign blend and small cap value both scoring a perfect 100. So certainly no concerns there. The DFA emerging markets continues to be marked for review. And again, that fund will be replaced tomorrow with the American Century Emerging Markets Fund. And then Carillon Eagle Small Cap Growth will be the one remaining fund that is marked for review in your plan with a score of 78. We've really talked a lot about Carillon over the past 3 quarters. We continue to believe that it's a well-managed fund. It's a fund that definitely, relative to its small growth peers, has a little bit of a value lean to it. And that's something that caused some underperformance in the last couple of years. Again, this real growth-driven market. Carillon ended up in 2020 having what I would consider to be a really solid year. The fund was up just under 38%, and it was in right around the 40th percentile peer relative. So we continue to believe that Carillon is a fund that we should be patient with. We think that it's a well-managed fund. There's been no management changes either in terms of personnel or approach. And if you look back historically, it's also been a strong performing fund that's just simply been faced with what we believe are some stylistic headwinds over the last couple of years. So we continue to have a hold recommendation on the Carillon Eagle Small Cap Growth Fund. And then rounding it out, you can see the Vanguard Target Date Series I mentioned had a really strong year. They're scoring a 93. We continue to believe that investors who want a well-diversified, age-appropriate investment strategy at a very reasonable cost, the Vanguard Target Date Series is an excellent choice. So certainly no concerns there. The CRUF Money Market is marked for review, but as you know, we're closing that to new assets as of tomorrow. And those contributions into CRUF Money Market will be directed into the Vanguard Federal Money Market, which we believe is just a better choice for the plan and for participants in the plan. So that will take place tomorrow. And then finally, your full suite of one more slide, but your full suite of index funds, you can see, are all in good standing as well, and certainly no concerns with your index suite. And then finally, CRUF Stock and TIA Real Estate, we break these out as what we call distinct asset classes. They don't really fall into our core scoring methodology. So what we want to do with these is break them out and really just apply an overall score of in good standing or marked for review. And in this particular case, we believe both of these funds merit the in good standing score. CRUF Stock, actually, where you have about 15% of plan assets, is coming off a good year. The fund was up almost 18% for the year and in the top third peer relative. So again, where you have high concentrations of plan assets, your plan and participants actually had a really good year. So overall, your overall plan score continues to be in the 90s. I don't consider that average score to be a hugely meaningful figure, but what I really like about this slide is it does show just the trend of the different scores, as you can see. And the one that I would point out specifically would be that Carillon Eagle Small Cap Growth Fund, where you can see it has been marked for review for a number of quarters now. And we've really shown a great deal of patience and ask that you continue to show patience as a committee. That fund is definitely trending up from a scoring perspective. from all the way in the considered for termination category in the third quarter of 2019 back into the marked for review category. And then we're hoping with the recent performance that that's a fund that will be back into good standing in the next quarter or two. So I will pause there and see if there are any questions on anything that I covered, or if you'd like me to go into more details on any of the specific investments before I turn it over to Barry to talk about fee benchmarking. Any questions at all? Okay, so I'm going to stop my screen share, Barry, and hopefully you can pick that right up.
All right. I thought, Mike, you were going to do that, so that's fine. I can get there pretty quickly here. I'm going to go to page 277.
Sorry about that, Barry.
That's all right. Can everybody see the screen okay? The good news, I think, just keeps on coming, as Mike described, especially some of those funds that are returning 50% in any given year. I think that the thing about participants is you got to say, hey, let's temper expectations, because 50% performance year is not something that we see very often. But you know, as a committee, there are fiduciary considerations with respect to the fees that you're paying. And this particular exercise, what CapTrust does is we evaluate the competitiveness of the TIAA administrative fees associated with the plan. The way their fee is structured, it's an asset-based fee based on the asset. So if you think about, we just talked about a really strong performance year, TIA gets a raise because we're on an asset-based perspective. So as a committee, there's really two things you need to understand: is what is the fee? So we're going to go through that today, but is that fee competitive in the marketplace? Based on CapTrust size and plans of similar structure, we don't have to go out to the marketplace. We have many plans that are in the same size and kind of demographic structure as a UMaine plan. So we'll show you a couple examples, actually 3 different examples of other plans that you can draw from to see if your fee is competitive or not. There's a typo here that should actually be 9/30/2020, the 1.7 billion. So we use 9/30 as a basis for this review. We have 7 plans, and the number of participants with balance, these are what's called unique participants. So you could have a participant that is in more than one plan. We're counting this once for this exercise. When record keepers look at pricing, one of the things they focus on not only is the asset size of the 1.7 billion, but also the average account balance. If you think about it, there's a cost to maintain a record on their website, on your call center, compliance wise. And so there's a fixed cost to maintain a record. So the higher the average account balance, the more efficient you are as a plan. So we'll talk about that as we look at pricing. So again, today, there's 2 forms of fees, obviously investment management fees. We can say that you are in, pretty much across the board, the lowest share class available to you in the marketplace. So we feel very comfortable from an investment management fee perspective that you are in that lowest share class, but we're really focusing on the administrative expenses associated with the plan. And for those that are unfamiliar, we've done this exercise before with the trustees, but this is a participant directed plan, and every fund might have different expense ratios and revenue sharing arrangements. So what you'll see here under the allocation tier, the CREF Social Choice that Mike described is a balanced fund. So that fund invests in both equities and fixed income securities. When you look at CREF Social Choice, as of the end of September, there was a little over $50 million in that fund. The total expense ratio of that fund is 24 basis points. Embedded within the 24 basis points is 10 basis points on the far right that is used to offset record-keeping costs. On the Vanguard target date funds, you'll notice that fee is 9 basis points across the board, but the Vanguard institutional funds do not share any revenue to offset record-keeping costs. So this is based on where participants invest their money. You can see CREF stock rounding out the allocation tier, total fee at 30, revenue share at 10 basis points. The passive tier that Mike just talked about, you can see anywhere from 4 to 8 basis points with 0 revenue sharing to offset record-keeping costs. Then we go to the next page where the active tier, and you'll notice, the funds that share revenue are the annuities. And when you add all those together, based on the funds that do share revenue, the plan right now is generating, you'll notice what down here, 1.432 million. So that's just a collective addition of all the revenue sharing of the funds that do in fact revenue share. Your fee that we had renegotiated about 18 months ago is 6.5 basis points. So based on that, we have an excess revenue of about $338,000. You use that to offset plan service fees such as cap trust. Periodically, you've given some of that money back to participants because we can't affect the amount of revenue sharing in the funds that do in fact revenue share. So we have this excess revenue situation. So what we're going to be assessing is that 6.5 basis points that TIA assesses today. One thing, this is not really for today, but one thing we do want to look at perhaps later this year and into 2022 is you do have a built-in fee disparity. So if I'm a participant today and I'm investing 100% of my money in the Harbor Capital Appreciation Fund, I'm not paying any of the associated administrative costs on the plan. So you have some people that are paying more than others. That's a longer conversation, but we are starting to have some of those conversations with clients to help eliminate some of that fee disparity. And there's a bunch of implications if we go down kind of that path, but that will be for another committee meeting. So we're looking at the 6.5 basis points. Just to let you know, Cap Trust over the past year, plans with greater than 250 million, we did 78 fee benchmarks. Actually, if you look at plans over $1 billion, of that 78, over 30 were associated with plans over $1 billion. So we have a pretty good cohort of plans that we can look at in terms of comparison of fees. So this is kind of I think the good news story ultimately is if you look at the top, we can see again the 1.7 billion, the average account balance, the current fee. Mike and I had several conversations with TIAA, and they came back and have reproposed bringing your pricing from 6.5 basis points down to 4.3 basis points. That correlates to about 350,000 plus a year in savings directly to participants. At the bottom are 4 sample clients, and there are certainly complexities. You think about your plan today, you have 7 plans, many plans that we advise on, or many clients may only have 2 or 3 plans, so there is a little bit of complexity on the UMaine plan. But you'll notice across the board at the bottom, these are all 3 of them I think are public university clients. You'll notice kind of based on average account balance, based on size, that 4.3 basis points is really in the bottom of these 4 that we have looked at. The first one, Sample Plan A, you're a little bit more expensive than Sample Plan A, but they also have an average account balance almost $170,000. So it's a pretty efficient plan to operate. So when you look at this, we feel really good that TIA came back to 4.3 basis points. Again, it's incumbent upon us when we have markets like we just have had over the last year or so to make sure that we continuously review this fee. But we think given what they're proposing vis-a-vis other clients that we have, and these are 4 other clients in the Cap Trust client base, that 4.3 basis points is competitive in the marketplace. So I'm going to stop there for questions. I want to make sure everybody fully understood what we just went through. Ultimately, we do need an affirmation from the trustees to accept, while we think it's a formality to accept the 4.3 basis points. We're not sure why you would ever say, no, we want to pay more in fees, but.
Any questions for Barry or Mike? I guess not. I have to say that it's always nice to finish up a meeting on a positive cost savings note with extra time on the clock as well. So thank you for that. And thank you, Mike, for your quarterly review commentary on the defined contribution plan. So that brings us to the text of the proposed resolution that the Board of Trustees, acting through the Investment Committee, approves the TIAA record-keeping / administrative fee proposal of 4.3 basis points. Do I have a motion?
So moved.
Okay, and that was that Trustee Donnelly?
Yes.
Okay, and a second?
Second.
By Vice
Gardner.
Chair Gardner.
Yep.
And I'll hand it over to the board clerk, Ellen Doughty, for a roll call.
Great, thank you. Trustee Bartholomew,
Yes.
Trustee Donnelly,
Yes.
Trustee Irwin,
Yes.
Trustee Gardner,
Yes. Trustee
Martin.
Yes.
The motion is carried.
Excellent. Well, I can give you back about 20 minutes of your of time to add to your day, and thank everybody. I'd like to thank everybody for your time today in the meeting. And I believe we're far enough in the week where I can wish all of you have a happy weekend. Be well and be safe.